Hit that now. Okay, we're good to go.
All right, good. So now we're recording. So again, welcome everyone to the Austin Women's Investing Group. This is our July 2022 meeting on bear markets. So thank you all for joining. You all know that I love talking about the stock market, so I'm really happy to be able to do this on somewhat spur of the moment. Just a quick introduction for those of you who are new to the group. As you can see from our slide that we have up here, we are a dynamic and diverse group of women who enjoy learning and sharing investing ideas in an all-female setting. So we've been around since 2011. My friend Michelle and I started this group back in 2011. So man, we're coming up on, we just had our 11-year anniversary in March. And when we first started the group, we would have it in people's living rooms, you know, on whatever day, you know, whatever time we could find a place to meet. And we would all just get together. We would have food and drinks and talk about whatever investing topics came up. The whole point is that this is a place where we should all feel free to ask the questions that are on our mind, right? So, you know, most of us don't get a chance in our normal lives to talk about money or talk about investing. So this is your chance. We need all different levels of experience to be part of this group. And that's what's made this group so amazing from the very beginning, is we have all different levels of experience across a lot of different asset classes and investing styles. So if you have a question, please ask it, because I guarantee if you have the question, someone else has the question as well. So we really need to hear the questions that are on people's minds. And on the other side, if you have an answer or a comment, please offer that too, because this is how, you know, our group learns, is just imagine us, you know, sitting in a circle and just having a discussion. We're trying to do that, recreate that virtually. And so we want to encourage as much participation as we possibly can. For this meeting, I will have some slides that I'll go through, some charts, which are always helpful when talking about the stock market. But we're hoping to leave plenty of time afterward for either questions and comments on the slides that I'll show you and the info that I'll give you, but also anything else that's on your mind. I know that some people have submitted questions in advance, which is super helpful. So we'll try to get through those. I think we found that what's easiest with a relatively large group is if you submit questions. Gwen will be going through the chat box and she'll, you know, stop me if she thinks it's time to stop me, or she might hold your question aside if she knows that there's a slide coming up where it might be more relevant. But certainly by the end, hopefully we'll have time to do some more Q&A. A couple just like disclosures, disclaimers. Nothing in this group is intended to be individualized investing advice. This is really important for me personally, because in my real life, I'm a financial advisor. And so when I come to this group, I come here as a participant and as a member of the group, not as a financial advisor. So nothing I say, nothing your fellow members say should be construed as individualized investing advice. If you need investing advice or legal advice or tax advice, anything like that, please hire a professional and they will give you that advice. So I think that pretty much covers what I need to cover in the first part. Gwen, did I miss anything?
No, I think you covered everything.
All right, so let's get on to our topic, the bear market in stocks that we're currently in. So let's see what we can see about it. Here's some disclaimer language that's at the beginning of at least everything that I present. Again, nothing is intended to be individualized investing advice. Definitely take a look at this if you're looking at this on the video, or take a look at the slide deck after we send it out to the group. Lots of good bullet points there. Here's just a little bit about me, Sara Glakas. You can really read all of this on LinkedIn or the Black Barn website or the Austin Women's Investing Group website, so I'm not going to spend too much time on it. But I do want to remind everyone that in the Austin Women's Investing Group, we have the kind of the main group, which is on Meetup. And so if you're a member on Meetup, that's where you get all of our invitations and all of our announcements for meetings. We also have a private Facebook group. So if you came in through one and not the other, I definitely encourage you to join both groups. The Facebook group is where a lot of side commentary breaks out. That's where you're able to go and ask questions as they come up in your life. And we also have a YouTube channel where the recording of this will be posted. And we have, at this point, we have a lot of videos from a lot of past meetings covering a lot of different topics. So definitely encourage you to check out the YouTube channel that we have and subscribe to that so that you get an alert when we put up new videos. Okay, so let's get into discussion about the bear market. So I'm going to start with some terminology, I guess. I've gotten a lot of questions over the last several months about the words that we use in investing, specifically about bear markets, recessions, like what are those things? So if we start with something that is just generally described as a market downturn, I mean, a market downturn is really what it sounds like. So if you're looking at a price chart, the prices start going down. So we can talk about the stock market in terms of the S&P 500 or the NASDAQ or the Dow Jones Industrial Average. You can talk about a downturn in the housing market or the bond market or the cryptocurrency market. It just means that prices are going down, but it doesn't really give you a ton more information than that. These downturns or price declines, they can be relatively short-lived or they can last a long time. So you don't ever really know in advance what flavor you're going to get. Are we going down and it's going to last for a long time? Or are we going down and prices are just going to, eventually bottom out and start trending upward again? A bear market is a little bit more specific than that. So a bear market is when the closing price of any asset, but here we'll talk about the stock market. It's when stocks have fallen by 20% from their most recent highs. So with the S&P 500, we hit our most recent highs, I think on January 3rd or January 4th. And then since then, the S&P 500 at one point had fallen by 20% and even below 20% from that high price that it reached in early January. That's what a bear market is. It's that somewhat arbitrary 20% decline level. Again, you can use the term bear market not only for the stock market, but for really anything that has a price, right? The oil market, the real estate market, the used car market, anything like that. But it's that 20% level that we're talking about. Here's a cool statistic. Since 1928, the S&P 500 has seen 26 bear markets and 27 bull markets. Bear markets are when prices are going down. So I think of a bear swiping her paw down, and a bull market is when prices are going up. So you can think of a bull's horns, kind of tossing someone into the air. And so bull market is a way to describe the phenomenon of prices going up. Now the term recession, right? So this is the one that everybody's getting kind of hung up on these days. What is a recession? It's important to know that the people that tell us that we're in a recession or we're in a recession is the National Bureau of Economic Research. So those are the people who decide what a recession is. It's kind of a loose definition. Here we see that it's a significant decline in economic activity that is spread across the economy and that lasts more than a few months. And it's a period when economic activity is contracting. So that is very general. I would say what most people look for is a period of time when the gross domestic product of the United States is negative. So GDP in the first quarter of 2022 was negative. I think it was down 1.5% from the previous quarter. It looks like we might have a negative GDP print in the second quarter of 2022, but that doesn't necessarily mean that the National Bureau of Economic Research is going to say that we're in a recession. They're looking for something that is broad. And so that usually means that economic activity is declining, and it usually means that we have layoffs or higher unemployment. So we will see, if and when the National Bureau of Economic Research says we're in a recession. But I know one of the things that a lot of people are feeling is the feeling like we are in a recession already. So maybe we are, maybe we aren't. If we keep going, this is from a really cool list that the Hartford funds put out. So I know I've seen it on the private Facebook group, and I actually had it pulled up in my notes too. So we just pulled out a couple stats about bear markets. When you're in a bear market, it feels really scary, and it starts feeling like prices only go down, right? Bear markets, though, in investing are normal. They happen with relative frequency. So if you're in the investing world, you just need to be prepared for bear markets to happen. So here, the first stat, bear markets drop 36% on average, while bull markets gain 114% on average. This bear market that we're in now, I think the S&P 500 got a little bit below 20%. Maybe we hit 22, 25% down, but we have not yet hit a 36% decline. So just kind of keep that in mind, that if this is a bear market, we might have farther to go. The average bear market lasts about 9.6 months. The average bull market lasts about 2.7 years. So this reminds me of my favorite investing quote almost of all time, which is bear markets take the elevator, bull markets take the stairs. So what that means is most times bear markets, when markets go down, they go down a lot and they go down fast. And that's part of what feels so chaotic about them. And it's part of what makes them so scary. So a bear market will go down relatively quickly. And when the recovery starts happening, the recovery is slow and drawn out, but it lasts a long time. So we almost never have what we call a V-shaped recovery, like we did in March of 2020, where the market went down really fast and then it recovered really fast. Most of the time, the stock market kind of looks like a check mark, where you'll have this pretty serious decline and then a long, drawn out recovery. And so we'll look at some charts and see that in action. Over the last 20 years, half of the S&P 500's strongest days took place in a bear market. So the bear market, or even when you're in a bear market, you can have these really large rallies or increases in value. I will say, like, over the last couple weeks, the stock market has been rallying. We don't know if it's the start of a bull market and the worst is behind us. Or on the other side, it could be what we call a bear market rally, which is when prices fall by a lot, they bounce back up. But really, it's just a, kind of a way station on the way back down to lower lows. So we'll look at some charts and see what we can see. I like this one. Over a 50-year time horizon, a portfolio can be expected to weather about 14 bear markets. So if you're a long-term investor, this isn't going to be your first bear, or this isn't going to be your last bear market. They're going to happen with frequency. So we need to figure out, everyone needs to figure out for themselves what they do during a bear market, right? Because knowing that before the bear market gets here is really, really helpful versus trying to figure it out for the first time when you're in the middle of one. And over the last 92 years, stocks have been outside of bear market territory 78% of the time. So when you look at a chart, you'll be able to see, like, the stock market trends upward. Most of the time, stocks are going up, not going down. But it doesn't really feel that way when we're in the middle of it. So it's good to kind of just put this current bear market into context. Any questions so far, Gwen, or should I keep going?
We don't have any questions so far, but if anybody does, feel free to stick them in the chat box, and then we can punt them to Sarah.
Here's a chart that I really like about S&P 500 volatility, right? So if anyone knows anything about the stock market, it's that the price changes can be wild, right? And so these gold lines at the bottom it's a measure of the daily price change in the S&P 500. Most of the time, the stock market is sort of calm. Like maybe stock prices go up by 0.5%, or maybe 1%, or maybe they're down by 0.5 or 1%. But every once in a while, we get these extreme changes in price. And I think you can see this on the chart. Hey, Gwen, are you able to see my hand when I'm moving my mouse around?
Yeah, we can see it.
Okay. So you can see we have these extreme increases in volatility, and they almost always coincide with massive declines, right? So if we think back to March of 2020, we had a day where the S&P 500 fell by 12% in one day, which was very unpleasant. It was also right next to a day where the S&P 500 fell by 9%, right? So we're getting these like very dramatic decreases in value for the stock market. And that is what makes the stock market, again, it's what makes the stock market so chaotic. And it is what scares people away from stocks over the long run. But I just want to remind everyone, we'll look at expected rates of return over time. When you invest in stocks, the volatility that you see in the price changes, that is why you should expect a higher rate of return over time versus investing in something that's perfectly safe. You can be perfectly safe and have no volatility whatsoever in your FDIC insured savings account or an FDIC insured CD, but you only get 0.5%, maybe 1% or 2% or 3% if you're in a CD. But the stock market historically has averaged returns of 9 or 10% per year on average. Investors get those higher rates of return from stocks by taking risk when it's risky instead of waiting until it's safe. So if we're looking back at this chart, and I'm really talking to long-term investors here, people who have like a relatively long time, like 5, 7, 10 years before they need this money. If you look back at this chart, you can see that so far, every bear market has been a buying opportunity. It's been an opportunity to either leave your money in stocks or put new money in stocks, and eventually the market recovers and it makes new highs. Sometimes it takes a long time, sometimes it takes a very short time, but so far, it's always happened. If you wait until it feels safe, the market will recover before you get a chance to invest. So just kind of keep that in mind if you're thinking about selling into a decline, or you're thinking about sitting out until it feels safer. The money that you make from stocks, you typically make by investing when things feel very risky. And here, if we stretch out that time horizon even longer, this goes all the way back to 1950. It's also on a logarithmic scale. So if we come back here to 1950, the S&P 500 started 1950 at a price level of 17.22. It ended today, I think this is a current price as of the closing today. It ended today at 39, almost 39.60. And so over all of these years, you can see there are these long-term uptrends. And then we get these relatively long-term sideways trends, long-term uptrends, long-term sideways trends. And here's where we are today. It's not the beginning necessarily of a long-term uptrend. It kind of looks like we're still in the uptrend that started back in 2013. But certainly as investors, the most important thing probably on everyone's mind is like, well, okay, Sarah, that's all great and good, but what happens next? But over long periods of time, you can see here that the stock market trends upward over time. So the longer that you have to wait, the better your chances are of making money in stocks. Warren Buffett, the patron saint of the Awesome Women's Investing Group. Here's a great quote by Warren Buffett. You shouldn't own common stocks if a 50% decrease in their value in a short period of time would cause you acute distress. Every once in a while, the stock market falls by 50%. And that is incredibly painful. So certainly, like if we're only halfway through what could be an incredibly painful period, it's something to get ready for. But let's just keep going and see, if it's time to panic, if it's time to not panic, if it's time to take advantage of an opportunity. So we'll just kind of go through some charts and see if we can get some information that allows us to make some investing decisions. First of all, just to go back, especially to people who are joining us for the first time, I know I just did a stock market presentation maybe 2 months ago, but just really quickly, just want to make sure that everybody knows what we're talking about. Stock is ownership of a company. So when you own a company doesn't owe you anything, if that makes sense. If you lend money to a company, the company has to pay you back by contract plus interest. That's bonds, loans, CDs, things like that. When you own stock of a company, you're one of the owners. And the price of that stock is simply where a buyer of the stock and a seller of the stock agree to make a transaction. So this is what's happening all day, every day on the New York Stock Exchange. The stock market in the US opens at 8:30. It closes at 3 in the afternoon, Central Time. And during that period of time, people who want to sell are putting their shares up for sale, and people who want to buy are bringing their money and trying to buy shares from people. And so that meeting of the minds where the buyers and sellers agree, that's what the price of a stock is. If you have more sellers than buyers, the price is going to go down until more buyers step in. If you have more buyers than sellers, the price is going to go up until more sellers step in. So the market is trying to give us equilibrium. Stock prices are always changing because investors' expectations about the future are always changing. We're here in the world getting new information every second of every day, and investors are synthesizing that information and making decisions about how to invest their money. Do you think a company is going to do well or do poorly? Do you think the economy is going to do well or do poorly? It depends on the information that you're taking in. How are you making those judgments? And so, there's millions and millions of people making these decisions and then kind of duking it out, in the stock market during every trading day. Sometimes people are very pessimistic. Sometimes people are really optimistic, but we're all in the market together. And kind of this chaos is really why the stock market is only appropriate for long-term money. There is a whole group, a whole type of investor that's in the stock market with you. And those people, instead of buying a stock or buying a mutual fund and holding on to it for a long time to take advantage of that chart that we looked at, there are people in the stock market who buy and sell stocks to generate their income, like it's their job. Right. So if you've ever heard of day trading, or if you are a day trader, you're trying to buy low and sell high so that when you sell that stock, that money is your income. That's really different from the way most long-term investors treat investing, which is I earn my money from somewhere else. I save some of it. I want it to grow over time. So I'm going to put it over here in shares of stock. And then I'm just going to let it follow that upward trend over long periods of time. So I think the first way of doing it, the buying and selling on a short-term basis, is incredibly difficult. For most people, it's impossible. But the earning money somewhere else, saving money and using it to invest in stocks and just letting those stocks trend upward over time is a really great way to make money over long periods of time. The difference is the time horizon. But from day to day, we're all in the market together. People who are in it for the short term, people who are in it for the long term, we're all participating in the same stock market. We're right in the middle of something called earnings season, which makes this particular moment in time really exciting. So today, Tesla announced earnings. So every publicly traded company, once a quarter, has to announce what happened in the previous quarter. And one of the main things they talk about is something called the income statement. It's also known as a profit and loss statement or a P&L or a statement of income. But what it's doing is it's taking the transactions that happened during the previous quarter and it's making them public to those of us who might want to buy or sell the stock. So at the very top of the income statement, we have something called revenue. So that's also known as sales or the top line. So if you bought a Tesla last quarter, good for you. And that money that you sent Tesla gets recorded in the revenue bucket. And Tesla just announced that an hour or two ago. The next thing that they talk about is something called cost of goods sold. So this is, think of it like the raw materials that go into making the product. The next thing that the company has to do is pay for operating expenses. So it's the costs of doing business, right? With the major expense being payroll, benefits, rent, software, utilities, things like that. The next thing the company has to pay is interest on any debt that it's borrowed. And then if there's any money left over, the company has to pay taxes. After all of those people get paid, there's something left over at the bottom called earnings. That's why we call it earnings season. This is the period of time during the year when a bunch of companies announce earnings, kind of basically at the same time. Earnings are also known as profits, net earnings, net income, and the bottom line, because it's at the bottom of the income statement. So this earnings number is what is so important to stock investors, because this is what's left over for the owners of a company. And remember, if you're in the stock market, you're an owner. So this number is really, really important. Generally speaking, if earnings are going up or are projected to go up in the future, the price of a stock will go up. And when earnings go down, the price of a stock will go down. But generally speaking. But what we're doing is we're trying to take this information that we have in the present, we're trying to forecast it into the future. So during earnings season, if you have a company that you're really either interested in following or interested in investing in, get on their earnings call. They're public. You just log on to the Zoom call or the WebEx call, whatever it is, and you can hear the people who run the company talk about not only what happened last quarter, but what they think is going to happen in the future. So that way you can get an idea as to whether you think this is a company that will become more valuable in the future or less valuable in the future. These earnings become super important because it's what price is based on. There is this really tight relationship between the price of a stock and the earnings that a company is able to generate. So I know some of you have seen this chart maybe 30 times. Maybe some of you are seeing it for the first time, but I'm going to show it again. What we have here on the gold line is S&P 500 earnings. So these are the earnings that the companies in the S&P 500 actually reported, right? So you can just, as soon as a company reports earnings, someone writes it down and they keep track of it over time. So we can see kind of the business cycle, the business cycle is cyclical. That's why they call it the business cycle, right? But we can see that generally speaking, the US economy expands, the companies in the economy get larger and are able to generate more profits over time. And that's what the gold line is showing us here. The white line is showing us the price of a basket of those companies. So the S&P 500, just think of 500 stocks in a basket. We're able to buy and sell little pieces of that basket. And they keep track of the price of the S&P 500 every minute of every trading day. So we can put that on a chart as well. And we can see here that most of the time, if earnings are going up, the price of stocks is going up. And if earnings are going down, the price of stocks are going down. And so we are here, right? For 2022, earnings are projected to be somewhere kind of around, I don't know, maybe $230 or $240 per share, something like that. Let's call it $230. So this is the number that Wall Street analysts have kind of come to consensus on. They look at all the companies, they say, okay, we think the S&P 500 companies are going to report earnings of $230 per share this year. And we think that it's going to go up next year, 2023, and that's going to be, let's call it 245. So if that's true, we would expect this white line, which is going down, we would expect it to come back up. Now, where this breaks down, and the reason why this line is going down, is because very few people believe these squares are accurate now. If there is a slowdown, if there is a recession, it is reasonable to assume that companies won't make as much money and these profit estimates are too high and they need to come down. So see how the stock market is anticipating that? It's reacting ahead of time to something that hasn't happened yet. We don't have this information yet because it's in the future. So right now, like at this exact moment in time, there's this kind of fight going on, right? People are looking at statistics, every statistics you can imagine. They're listening to companies report earnings, and they're trying to predict where these little gold boxes are going to end up in 2022 and then next year in 2023. And that is absolutely what is driving the movement in the stock market. It's really, really difficult to estimate earnings, right? You need to be able to forecast a very complex system, not just the US economy, but the global economy, right? It's hard enough to do if you're looking at one single company. Now think about all the companies in all the countries and try to synthesize all of that information. It's incredibly difficult, but that's what the stock market is trying to do. And so right now, it looks like it's telling us like, these earnings forecasts are too high. We don't believe that companies will do as well in 2022 and 2023 as people thought. So I'm going to go ahead and stop here because often people will have questions or comments about this chart. Oh, and like the sources down here too, if you're interested in that. Ed Yardeni is an economist who every week updates not only consensus earnings, but his own earnings projections. So if you're, feeling like this is something you want to know more about, I highly recommend Ed Yardeni's earnings reports that come out every week. So what questions do we have here?
So we haven't received any questions yet in the chat box, but I want to pull something from a question that was submitted from somebody through the Meetup event page. Someone submitted this question: are we in the same pattern as the .com bubble that we see here?
Oh, what a great question. Hopefully whoever asked that question is on the call. If not, thank you for submitting it ahead of time. Okay, so great question about bubbles. So luckily on this chart, we can look back here and see what a bubble looks like. So the .com bubble back here, kind of 1998-ish to 2001, 2002. If you remember, if you were investing during that time or working during that time or alive during that time, you can probably remember that during this period of time, the internet was just starting to take off, right? And so any company that was internet related, people were just really excited about it because the internet's going to change the world, right? The problem is that the price that people were willing to pay for companies went up. So the white line goes up, but the earnings that those companies actually earned did not go up as fast, right? So when you get that white line pulling away from the gold line, you get a bubble. And so this, kind of started off innocently enough, but the bubble grew and grew and grew. It got farther and farther away from that gold line. And eventually the stock market collapsed, right? And the white line came all the way back down and met up with the gold line again. So this is definitely something that people are talking about now, that this over here, right, was also a bubble. We can see here that the white line, after that, very sharp, very serious bear market in March of 2020, we went down and snapped right back up and went really high, right? So the last 2 or 3 years have just been very strange in the stock market. And that white line, you can see how far ahead the white line got of the gold line, but directionally, the stock market was right? The stock market was predicting that the economy would be okay and companies would generate earnings and we would have a decline and then a rebound. And that's what happened. The white line kind of kept going. And since then, it's come back down. So if I'm looking at this, I would say maybe some argument could be made that this was a little bubbly kind of here going into the end of last year. But this gold earnings trend line, was also going up by a lot. If you look over here, for a while, earnings weren't going up at all. And then they kind of started trending upward. This is what I would look at to say that this isn't the same as 2000, 2001. Certainly, the prices of stocks have come down, but I don't think as many of those companies were in a bubble as were back here. I certainly know investors who disagree with that, but just looking at this, it looks like if there was a bubble, it was kind of relatively short-lived and didn't really get a chance to over-inflate, at least in the stock market.
Okay, quick question from Denise. Is earnings season once a year or quarterly? How often does it happen?
Yeah, great question. So it's once a quarter. So all these companies report quarterly. It typically happens big banks start reporting earnings the second week of the quarter. And then just more and more companies, if you start noticing this, or if you just Google earnings calendar, you'll be able to see all of the different companies that are reporting earnings over the next few weeks. I would say kind of July, so maybe the last 3 weeks in July are going to be the most important so they're reporting, most companies are reporting second quarter earnings, right? And what makes it, so interesting is because all of these, it's all clumped together, right? So if you're a stock investor, you're going to start getting a lot of information really quickly from a lot of really big and important companies. And that'll happen once a quarter. All right, should I keep going?
Yeah, I think those are all the questions for now. So we can keep going.
All right. This is just another chart that I really like sharing. It shows this that trade-off between risk and return that you talked about at the beginning. When you are in the stock market, you should always, always, always assume that the path is going to be volatile. Nobody really cares when it's volatile to the upside, right? But people care a lot when it's volatile to the downside. And you're going to get both of those things in the stock market. But this shows, so this is information from 1995 to 2020, so actual results. And we see 7 different asset classes here. So we see cash down here, this little gold diamond. We see bonds here, US bonds. We see large US stocks, so that's the S&P 500. Small US stocks, that's the Russell 2000. Real estate, this is commercial real estate. Non-US stocks, so that's international stocks. And down here, we had commodities. And so what this is showing is on the x-axis. Is that the up and down axis or is that the y-axis? Every single time I get that wrong. On the up and down axis, we have... What's that?
It's the y-axis.
The y going up and down. Okay. On the y-axis, we have the compound annual returns expressed in the percentage. So that's that rate of return number that we were talking about before. On the x-axis, going across, we have another measure, standard deviation of annual returns. So I'd like to think of standard deviation of annual returns as the measure of how far away from a trend line your actual results are versus what you expected. So with large US stocks, people kind of expect 9 to 10% per year, but you never actually get 9 or 10% per year. You get, plus 25% or minus 30%, right? Your actuals are going to have a really wide range, sometimes very large, sometimes very low losses. And so here we can see there's this trade-off. If you're in low volatility, low risk assets like cash and US bonds, your expectation should be you will end up with lower rates of return. If you're out here on the risk spectrum, and this is for long periods of time, it is reasonable to expect that with US stocks, at least, even though there's a lot of volatility and your standard deviation is high from year to year, your average annual rate of return will be much higher than if you played it safe. So this is the risk return trade-off. This is why you would put your dollars at risk of falling in price. You would do that because the expectation is A, it's temporary, and B, if I wait long enough, I'm going to end up with way more money than if I had just played it safe. So this part is really important. I know in the past we've done time value of money calculations showing different rates of return. With stocks, we expect the stock market to double every 7 to 10 years. We expect cash to double every, maybe 35 to 40 years. So most of us, because we're trying to accumulate wealth, we're trying to get on a doubling cycle that happens faster so that we end up with enough money to have a secure retirement. That's what most people are saving for. But you shouldn't expect a high rate of return unless you are taking risk. On this chart, that risk is standard deviation. Any questions on this? All right, we've looked at this chart before in the past too. Again, it's just like the trade-off between playing it safe in something like US bonds and putting your money at risk in something like stocks. The green line is US stocks. This goes all the way back to 2006. So you can see that you would have had to suffer through a 50% decline in 2008, 2009. But if you'd hung on from 2006 until today, you'd be up 179%. If that whole time you decided to play it safe in, say, a bond fund, your money isn't moving very much. It's never falling by a lot, but it's not growing either. So up over that period of time, you'd be up 2% after this most recent decline in the bond market, though you would have received interest payments along the way. But most people who need to end up with more money than they currently have probably need to invest in such a way that they're closer to this green line. If you already have enough money, awesome. Then maybe you want to be on the blue line, right? And you want to keep all this money you have, you want to keep it safe. But if you don't have enough yet and you're on your path there, you probably need to be in something that has potential to grow over time. That's what the stock market is for.
So, Sara,
yeah.
Out of curiosity, do you know where cash would be on that line? Because I know people that don't like to do the market, and they probably don't really do mutual funds and bonds, but they save things in cash. And that's especially true with this environment. Where would cash be, do you think?
Yeah, so I think cash would be a line very close to the blue line, but straighter and lower return. Like it might be zero or closer. It might be close to zero, but perfectly flat over this time period. Right? So cash, if we're just talking about dollars, in the US, we have FDIC insurance, right? Like your dollars aren't going to change. You might, if you invest $100,000, maybe over these years, you've accumulated a little bit in interest on your savings account. But it's going to be, the line is going to be under the blue line and much flatter. I mean, and certainly over this time horizon, Lori, I mean, you're not, even after this decline in the stock market, you are not better off in cash, right? You were perfectly safe over that time horizon. I will say, if you were in cash during 2022, it's one of the best performing asset classes this year, right? Year to date. But so, if your plan is to stay in cash for decades, then that's probably okay, as long as you already have enough and don't need any more, because you're probably not going to get much more.
So even though interest rates are going up, with inflation going up, it seems like it's going up faster than interest rates. So if you have your money in cash right now, like not looking long term, but like right now, it's actually losing its value. Is that true?
Yeah, I mean, that's a really awesome point, right? Because you hit the nail on the head. These numbers are what we call nominal rates of return, or nominal percentages. They're not adjusted for inflation. I have another chart where the returns are adjusted for inflation, but imagine, from 2006 to 2022, inflation wasn't very high. Maybe it averaged 2% per year. So if your cash account was at 0 and inflation was at 2, or at -2, inflation was at 2, then your rate of return is -2% per year. Stocks did way better than that, right? So stocks gave you a big return on top of inflation, and bonds probably broke even thereabouts, but cash didn't keep pace with inflation. This year, inflation is very high, and that has been bad for the stock market and bad for the bond market. So for the first 6 months of this year, cash has been one of the best places to be. But when you think about that over the long run, there's no way that can hold up over the long run. Things will even back out over some period of time, even if it's very painful. Cash will just kind of continue to go sideways. Even now, I don't know, what are y'all getting in your Ally high yield savings account? 1.25, 1.5, maybe 1.75 now that the Fed just raised rates again? It's still not enough for most people. Again, with the exception for people who already have enough to sustain them throughout their lifetime, right? If you have $5 million and you only spend $50,000 a year, you probably don't need to put your money at risk. You'll be able to cover it for a long time, right? But most of us aren't in that boat. That's a really good question. I do have some inflation slides too.
Great, thanks.
Oh, hey, here's our 2022 to date chart. So going back, Lori, to your question, if you were in cash, you'd be on this gray line up here, right? Kind of going sideways at 0%. You'd probably, now that interest rates have ticked up a little bit, maybe you'd be at 0.25 or 0.5% this year. Bonds struggle during times of inflation. So bonds are down almost 11% on the year. The S&P 500 has been horrible as of the close today. It's at down 17% this year. And then the NASDAQ, which is, I put the NASDAQ in there because the NASDAQ is tech heavy. So it's usually what people use to talk about the tech sector. The tech sector is down 24% this year. So even more than the S&P 500. I mean, so this just isn't looking that awesome this year, right? But that looks a lot better. We kind of stretch out our time horizon. But this year has been painful for sure. So what is happening, right? Like I went through these in one of the last presentations I did. So I'm just going to go through this really quickly. The main thing that's happening is inflation is the only story of 2022. It's the only thing that matters. How long will inflation be hot? How and when can we expect it to come down? Everything else is kind of keyed off of this number right now. The decrease in bonds, which are generally a safe asset class and have not been this year. The NASDAQ being down so much. These beloved stocks like, people's Apple and like even those stocks are down by a lot. It all kind of comes back to this inflation picture. So once that starts moderating, then maybe we would expect the stock market to find its footing. There is some indication that that is happening like as we speak. So, but we don't know, right? Because when we measure inflation, we're measuring what happened in the past. And a lot of people are looking at different measures to see if they can predict inflation going forward. So things like oil prices going down, gas prices going down, housing or home prices going down, right? Which nobody thought would ever happen, but has been happening. The price of lots of different commodities is coming down. As those prices stop going up and start coming down, these inflation numbers will come down too. But no one really knows the rate, how quickly they'll come down or to what level they'll go and how long it'll take to get there. So that's what's new since the last time I talked to you guys, right? Oil and gas are down. That's the big news. Copper is down. Copper is used in lots of different things. So when an economy is slowing down, copper prices tend to predict that because builders and industrial uses are down. Bond yields have come down. That's important. When there's inflation, bond yields go up, and bond yields have stabilized. They've stopped going up. I'll show you here the leading economic indicators chart is starting to roll over, which might not be awesome news. We can look at the Fed's GDP now chart, which I showed you a couple months ago. So I would say here the leading economics indicator rolling over and the Atlanta Fed's GDP now measures are showing weakness and maybe recession, but there's still strong hiring data and still strong employment numbers. People aren't really getting laid off in any sizable numbers, and there's still strong earnings estimates. Netflix yesterday reported their earnings, and investors had been expecting them to lose 2 million subscribers, and they lost less than 1 million subscribers. And that was enough good news for the stock to go up by 7 or 8%, right? Like the news that was actually reported was less worse than people expected. And in a market like this, it's kind of all it takes. Once people really start getting gloomy, all it takes is for things to be less bad than you thought for the market to start recovering. So there's a lot of conflicting signals out there. It's just a really tricky time. But that's what makes it fun. And it's why you expect a higher rate of return over long periods of time, because it's not easy.
Hey, Sarah.
Yeah.
Real quick. I think, Betsy, do you want to unmute and ask a question? Oh, sorry. You're still muted.
What that was so interesting to me when you said that when the prices of housing and the prices of gas go down, that inflation will go down, because the expectation that I seem to have is that more people are going to lose their jobs, and more and people are, without the subsidies that people have had, and they're going to have less money to spend, and that I thought that would make things worse. But I like what you said, but I don't understand it in terms of what I thought before.
Yeah. I mean, that is an awesome, awesome question. I don't know how, some of you probably follow the Federal Reserve Most of you probably don't. But one of the things the Federal Reserve has been talking about is this idea of a soft landing. So you've probably heard that term, soft landing versus hard landing. The idea of a hard landing is that, just like you said, Betsy, you know what cures inflation? A recession, right? If the economy slows down and people lose their jobs, that will fix inflation, but in a very unpleasant way, right?
Right.
People, that is the way that we do not want inflation to come down, but it's a risk, and the risk is getting higher every day that either is what's going to happen or it's what will have to happen in order to bring inflation back in check. So that's the hard landing scenario. And so, you're exactly right. Like that is one path, and it's the one people are most scared of for good reason. The other path is the soft landing path. And it's this idea that if we can just figure out how to better match up supply and demand, which maybe will just take time, that maybe we don't need a recession, right? Because there are some things you can probably think of that are pandemic-related supply issues and pandemic-related demand issues. Maybe like an obvious one is every single person in the United States trying to get on an airplane this summer. Right? Lots of demand, not so much supply, right? Like there's no pilots there. There's no airplanes. It's a mess. It's a total mess, right? Or kind of the story from Target and Walmart. Like they ordered all of this Christmas stuff last year that got to their stores in January when nobody wanted it, right? And so there's all of these like supply demand mismatches that maybe if some of those can get evened out, maybe instead of a hard landing with a recession, we could have a soft landing where there's a slowdown. People stop demanding so much all at the same time. Suppliers catch up as the global economy reopens, and maybe it doesn't have to be a recession, or maybe it doesn't have to be a severe recession. I'm still hanging on to the soft landing camp, but certainly there's a case to be made for the hard landing recession camp, right? You just have to be, for all of the reasons that you already know. Yeah. So that's what is making this time, it's so confusing because like these, there's still strong employment. That part hasn't rolled over, right? And it seems like companies are not hiring as much or letting people go through attrition, but they're not necessarily laying people off. And the people who do get laid off or who switch jobs can find a new job relatively quickly. That's not like in a recession, you would expect people to be unemployed for longer. So that's a really good question and one that I don't know the answer to, but those two camps, like the soft landing camp for optimists and the hard landing camp for pessimists, will probably, it'll probably lead you to invest in a certain way, depending on what camp you're in.
Thank you.
Yeah, you're welcome. That's a great question. And so kind of along those lines, talking about the economy and jobs and recessions and things. So here are the actual GDP numbers going back to 1997. So they report GDP numbers quarterly. And then the forecast is in gold. So this is still a positive number. I will say that economists don't typically do a great job of predicting recessions. So the forecasts always kind of look like this. It's always like, we think it's going to grow by about 2 to 3%, right? So the stock market seems to be forecasting recession, but economists are not as of now. Another way we can look at this is start looking for indications. Instead of asking an economist, you can look at, it's like people putting their money where their mouth is, right? And that's people voting with their dollars. So here, the US Index of Leading Economic Indicators, and it's published by the Conference Board, Leading Economic Index. You can follow this and get it publicly. And so you can see that ahead of every recession, this blue line, which is leading economic indicators, leading means future. The gray line is the coincident economic index. So that's trying to chart what's happening right now. You can see that the leading economics indicator has started to roll over. And that has happened at some point ahead of, if you keep going back, it's before almost every recession. It's a really good indicator that the economy is slowing down, right? Where you have this rollover. And so that is rolling over. So it is a signal. I think last time I spoke to you all, it was a couple months ago, and this chart was showing that it wasn't rolling over. And then there were 2 months with new data. It's like, oh, shoot, now it is rolling over. That's not awesome. If we look back all the way here, you can see the LEI index, it didn't roll over, it rolled over in what, like kind of the beginning of 2006. And we didn't have a recession until mid 2007. So it was really, really early, but this is something to keep an eye on. I keep talking about the GDP Now forecast. You can go to the Atlanta Fed and see their GDP Now forecast. They get new data and then they update this model. Again, I think 2 months ago when I was talking to you guys, I was like, hey, the Atlanta Fed is showing that we still have positive GDP expectations for the second quarter. And then a couple of months came in and now we're negative. So again, not an awesome sign for the economy. It's definitely something to keep an eye on. And the reason that it is important if you're a stock market investor is the most dramatic stock market declines are associated with recessions. So if you have a recession, you almost certainly have lower earnings. And if you have lower earnings, you have lower stock prices, right? Though, again, remember that with the stock market, it's forward looking. So the stock market will almost always decline before the recession hits, and then it'll start recovering before the recession is over. So don't get too hung up on using the recession to predict where the stock market is going. It's almost always the inverse. From an individual investor's perspective, I think where this has the most impact is if you're investing in stocks, and let's say you have all of your money in stocks, the stock market falls, and then there's a recession and you lose your job. And now you need to sell your stocks, which are down by 40 or 50%, in order to replace your income. This is where people's financial plans get completely blown up. You do not ever want to sell your stocks into a decline because you're just incinerating your wealth. So that's where the emergency fund comes in, or the ability to really tighten your belt. I mean, all of those things. It's like the personal finance side of investing. Like what you don't want to sell your stocks into a decline in order to pay the bills. And that's where recessions really get people. It's the biggest risk isn't the market decline, it's losing your job. So, here looks like it's already, the market does fall, without there being a recession. So just because the market's down does not mean there will be a recession. But, a lot of times it is predicting a recession. So we should be mindful of that. Here's an inflation slide just for people who are, keeping track of inflation. The blue line is headline CPI. So that includes food and energy. Core CPI, which is the red line, excludes food and energy. And so we can see that, kind of over the recent past, inflation has kind of been, around 2.5% per year. So this recent trend, going back to the mid 90s, there have been times when it's spiked up and when it's fallen by a lot. And here's a spike. It doesn't necessarily mean that we're going to start this upward trend of inflation. This is not a foregone conclusion that this is going to be like the 70s. Everyone seems to be on the same page that we need to bring inflation down, whether through a soft landing or a hard landing, right? Which will mean that it'll get broken before it starts this long upward trajectory. Of course, anything can happen, but I think that almost everyone, the Federal Reserve, politicians, everybody's on the same page that we can't let this get going like in the 70s, that there's a spike and we're going to try to bring it down. And like Betsy mentioned, like one way to bring down inflation is to have a recession. Hopefully it doesn't come to that, but we don't know yet. I also like showing this because it's like, as painful as this inflationary period has been, it's not completely unprecedented. We are not that far off from year over year CPI spikes in 2007, 2008, 2005-ish. I mean, so it's not like completely unprecedented, even though it is very painful.
Hey, Sarah.
Yeah.
I think I see a raised hand. Oh, Caitlin, do you want to unmute and ask your question?
Are you surprised I didn't just interrupt and say yes?
I thought you saw the button and were like, press.
I'm practicing. Okay, Sarah, I'm still on what you said about the problem isn't when there's a recession. It's not that the stock market is going down and our investments are decreasing rapidly, precipitously in value. It's that the double whammy of having your stocks go down and losing your job, or having some other economic thing not in your investing that goes south. So you need to take out that money wherever you have it. Would then the therefore be right now, if you are anticipating a recession, that you stop investing and you start stockpiling cash so you wouldn't have to do that? Like that you start thinking about, okay, my cash reserves, usually I keep a 3-month, emergency fund. Now I need a 6-month one or even a year long. And I'm going to prioritize that completely over stocks to avoid that situation.
That is a great question. I mean, and I would say yes. I would say now is the time for every single person. And this is what I've been doing with clients for the first half of the year. It's check in with yourself. Every single person needs to look at what happens if I lose my job, right? How long do I expect to be out of work? Where can I cut money from my budget? And do I have enough cash set aside to cover expenses for the amount of time I think I'll be out of work? And if you haven't done that already, then now is the time to do that.
And so you, investment advisor, though you're not here in that capacity, might sign off on a plan for people who have to really make hard choices. Like I'm either putting $200 a month in my savings account and $200 in my investing account, or all $400 in my savings account. That would make sense for people that are closer to the margin than others to the moment, put a pause on investing and just prioritize the cash part.
Yes, absolutely. And I think that it encompasses cash savings. It also, if you're willing to get creative with it, it's also lining up easy access to lines of credit if you have them available to you. So are your credit lines clear? Do you have a home equity line of credit already lined up that you could tap in an emergency? Those are all low cost, safety measures that you can be putting in place. I have this many months of living expenses. If I run out of living expenses, I could use my credit card for 2 more months, or draw down my line of credit for 2 more months. And then as soon as I get a job, immediately pay those things off and kind of work the whole thing in reverse.
Wow.
And kind of worst case scenario it.
So you're saying the last thing in our safety boat is selling our stocks. Everything else, borrowing money, putting stuff on credit cards, all that stuff goes first?
The borrowing money is if you want to get creative, and this is probably people who fall into a more aggressive risk category. Like at this point, like after a 25% decline in the stock market, the way that my mind thinks is I'm like, well, you know, I want to be there when the market rebounds, because when the market rebounds, I'm not looking for a 2 or 3% rate of return. I'm looking for a 30% rate of return in that short period of time. I don't know if the market's going to fall farther while I'm waiting, but I don't want to, I'll do whatever it takes to not sell my stocks, right? Even if it means borrowing for what I expect to be a short period of time after I've run through my savings. If I'm still out of work, you know, I'm willing to do a lot of other draconian things before I sell my stocks.
Wow. Okay.
I'll move to Petaluma and move in with you. I would move in with my parents. I would, there's a lot I would do before I sold my stocks, but that's not true for everyone, right? This is why, like, everyone needs to look at their own picture and what resources they have available to them and figure it out on their own, right? Because it's a really big difference. Like, can you rely on family versus people who can't, or people who have family who rely on them, right? Like, you have to look at your own situation and be realistic about what happens if you lose your job in a recession.
Yeah.
But yeah, it might mean hitting the pause button on your 401k so that you can bulk up your savings for a couple months.
Okay.
Well,
Hopefully you've already done that, though, all of you investing women. You know, hopefully you're already at least part of the way there on that emergency fund.
I was going to comment on Studio 1A that I heard today, and they were talking about inflation and savings. And the question was posed, what should I do if I can't even save 3 to 6 months? The lady who was answering, she grouped people into different categories. If you can't save 3 to 6 months, set aside a target, like maybe $200, $500, and start putting money aside there for when you lose your job, or when your car breaks down, or when you need a new AC, and get that money stashed away. And she said, if you have some savings, make sure you have 3 to 6 months and expand it to a year. And then she said, if you think you have a lot of savings, make sure that you're okay, but don't pull out of the market, because then you're just locking in your losses.
Yeah.
And maybe then you look and see, are you that family member that can help other people? I thought it was an interesting way of looking at it. But yes, she was definitely recommending that, since it's kind of uncertain right now, that you make sure you have things stashed away. And she also was talking about, what do you do if you have debt? Should you make sure you pay down all your debt first, or stash away money? And she was of the philosophy that you split it. Some you stash away and some goes towards your debt. And I would actually say some goes in your savings and some goes in your stash, because I recently started transferring over a 401k, and I had put in a minuscule amount compared to how much I got out based on my earnings and how much my company matched. And that was because I did the set it and forget it. I just poured money in there. I actually had it in like a market fund and just left it there. So I don't think you should totally stop putting money away in your savings, because, you know, that's your long term, and that you want it to grow over long term. But yeah, she was saying that you do want to go ahead and stash away money right now, just in case. And I'll put a link to that Studio 1A podcast. I thought it was really interesting.
That is awesome. Really good idea. And I like how you circled back to like getting your company match if you're in a 401k, like taking that still saving enough in your retirement account to get the free extra money that they want to give you, if you have that available.
Yeah, that made a big difference to me. Whenever we get to the end, that's one of the topics that we want to talk about, 401ks and IRAs and what we should be doing right now. So yeah, that's one of the topics we want to talk about, Sarah.
Yeah, great.
I do see that Tatiana has a hand up, but real quick, just on Emily's point, Sarah, can you clarify what you mean when you say, are your credit lines clear?
Oh, yeah. Like if you have a credit card, do you have, like if you have an American Express card with a $20,000 limit, do you have $20,000 available, or are you carrying a balance? One of the things that I try to do every year is I try to go through all of my credit cards. I think I have 4 maybe, and I make just a super simple spreadsheet that tells me the credit line, so the amount of credit I have available, the balance. I try not to carry balances, right? But if you have a balance, you put in the balance, and then you see how much is available, and then I make a little chart with the rates, so that if something like this happened and you if for whatever reason you think like, okay, I'm going to make the choice to use credit for some temporary period of time to do something, that you can start with the lowest rate first. And you can also see how much credit you have available on your credit lines. So by saying like, is it clear? It means like, do you have balances that are hanging out there that you could get rid of? Or pay down a little bit and give yourself some room.
Thanks, Sarah. Okay, Tatiana, thanks for being patient. I see you have your hand up.
No worries, thank you. Hi, Sarah. Hi, Gwen.
Hi.
So my question is, my daughter saved over summer her money, and she's going to college. And her plan was opening Vanguard and, every month adding whatever she saves from work. So my question is it smart to open it right now? Should she wait maybe a few months?
Can we come back to that in just a couple slides?
Yeah, of course.
That's a great question.
Okay.
Yeah, don't let me forget. That's a great question.
Okay.
And probably what everybody's thinking too.
That's exactly what I was going to say, is that this exact question keeps getting asked, both in the chat and also like in different iterations. It was submitted to the questions for the event. So definitely something to circle back around on.
Yeah.
And
awesome.
so if I could add to that question, so if it's not good timing from Vanguard, is there any, like maybe sitting in the bank, but is anything between the bank and Vanguard that, would be more beneficial sitting money there instead just bank saving?
Awesome. Put that in the queue too. That's a good one. Okay.
Thank you.
Yeah, really, that's the only question we have as investors, right? Should I do this thing right now or should I wait, right? Well, let's keep going and see. I just have a couple more charts and then we'll get back to those perfect questions. We looked at inflation. Here is my stock returns chart, nominal versus real. Real means inflation adjusted. So stocks are actually a really good inflation hedge, because if we go back to this chart about how companies work, companies can adjust their prices, which impacts the amount of revenue they can collect. They can also adjust their operating expenses by laying people off sometimes. So there's actually a lot of flexibility in companies and stocks, some more than others, to kind of preserve the amount of earnings that they're able to generate. Anyway, like long story short is that stocks tend to be really good inflation hedges over long periods of time. I know that has not been the case this year, in the first 6 months of this year, but we would expect it to be the case going forward. And so here over, this goes back to 1935, we can see this is over decades and decades and decades, right? This red line, which is the nominal rate of return, tends to kind of fluctuate around this 10% trend line here. And if we adjust it for inflation and say, okay, well, on top of inflation, what is it? I mean, it looks like it's kind of trending around this 6% trend line on top of whatever the average rate of inflation is. So that means the way to think about it is over the long run, your stocks, hopefully, if the future is like the past, your stocks should return 5 to 6% on top of inflation, whatever inflation is. With bonds, that's not the case. If you buy a 3% yielding bond today and inflation is at 3%, your real rate of return is 0. The bond cannot adjust for inflation. That's what makes bonds a terrible investment during inflationary times. Stocks actually do have a way to adjust for inflation. So if you're worried about long-term inflation, as long as inflation over the long term stays like in a kind of normalish range of, let's say, like 2 to 5 or 6% per year, which is higher than what we've expected. But if you look back over time, if inflation stays in kind of a normal range over a long period of time, stocks should still do okay. So just take that for what it's worth. And then like the predicting where the market is heading, this kind of goes back to, is this a good time or will there be a better time in the future? I don't know, right? We have kind of all of these things that have happened in the past and that will continue to happen in the future. I mean, the most recent, shock was the invasion of Ukraine, right? That just snarled supply chains, messed up the energy structure, and kind of made a lot of the problems we had post-pandemic worse. And so like going forward, I would say like the way that I approach the stock market is if I'm making a prediction 1 year out, I would say the stock market might go down more or it might go up or it might go sideways. I'll just tell you that like in the short term, I watch a lot of financial news. And so I try in my mind to figure out where the consensus is. That's like, okay, what do people keep saying? And most professionals, I would say, are saying, we think that the stock market has farther to fall. We're looking at a price target of 3,400 on the S&P. It's at 3,900 today. We hit 3650 or 3630 a month ago. But a lot of people are saying there's more pain to come, that we haven't worked our way all the way through this. Now, after the last couple of weeks, again, like the news that's coming in from companies actually reporting earnings and forecasting, the news is not as bad as people thought it was going to be. So it doesn't take very much for people to change their minds and say like, oh, well, maybe there won't be a recession. Or if there is a recession, maybe it won't be that bad. Or, maybe certain companies are actually going to do well in this environment, and that gives the market some support. And so to get around that inertia, like if you're a long-term investor, please don't set the precedent for yourself of trying to predict the best price to buy stocks at. Because you're never, ever, first of all, you're never going to get it right. And second of all, you're always going to be stuck in this pattern of, I have $1,000. Should I invest it today? Or should I wait for 2 weeks? Or should I wait for 6 months? Or should I wait for a certain price? And you're going to get caught in analysis paralysis. And that is something like I'm pretty sure of because I see people do it all the time. And I also like feel it in my own cogs and my own brain. And so what I would say is for, your daughter, Tatiana, or for those of you who have money sitting on the sidelines that maybe you have your emergency fund sewn up, you have some extra money that you're looking to invest. What I found is the best way to get over that paralysis is to take that chunk of money, chop it up into smaller pieces, and invest it a little bit at a time over some finite time horizon. So if you have $10,000, cut it into 5 pieces, $2,000 a piece, and say, okay, I'm going to invest this I'm going to invest no matter what. I'm going to invest a piece every week for 5 weeks or every month for 5 months. I'm going to have this money invested by the end of the year, and then I'm just going to let the market do what it does. That is by far the easiest way to do it. You're never going to get it exactly right. But if the market falls, you'll still have money left to invest as prices go down. And if the market goes up, you will have gotten some piece of it in at lower prices. So it kind of turns into a win-win. Because this is like kind of the level where the stock market is now. It does come back to this unanswerable question. We won't know it until it happens. If we look back at, where's that chart with my recessions on it? If the economy deteriorates and we have like a somewhat, this doesn't even have to be severe. If we have a recession, then the stock market might have another 15, 20, 25% to fall from here. But that question of recession is a big if, right? If you can make it through a recession, even if you invested here, right, in, let's say, mid-2008 during the Great Financial Crisis, and you had to gut through another 25% decline, guess what? This still looks like an awesome buying opportunity over the long run, right? It's way better than up here. Not as good as if you had waited and somehow timed it perfectly down here, but you're never going to know what the bottom is, because the reason the prices are falling is because the news is so bad. And so your brain is going to say, well, the news is bad. Like, how could this ever get better? I'm just going to keep waiting because it keeps getting worse and worse. But eventually it'll stop falling. So that idea of just investing little chunks along the way is really helpful to just get the money invested, especially if it's like your daughter. Like, I'm assuming she has like a long investing life ahead of her. Like, whether she invests here or here or here, it's all going to be good over a 10 or 20 or 30 year time horizon. But what is not good is missing the opportunity, sitting on cash while the market runs away from you, and then you're waiting for the next crash. I hear investors do that quite a bit too. The market starts running away from you, and then you say, well, I don't trust the rally. I'm going to wait for it to crash. And look how long the market can go up without crashing again. It can go up for a long time without crashing again. So you don't really want to get caught in that short-term prediction game. And I know that's easier said than done, because it is incredibly painful to just white knuckle through a bear market. Again, this is why you end up with the higher rates of return over time. And it's why so many people just get flushed out. Every time this happens, people just get flushed out because they're afraid. So I don't know if that is, I don't know if that's helpful, but I would say, like, that timing question, I mean, at some point you kind of just have to hold your nose and get in there so that you are part of it. Even if the market goes down more, eventually it's going to go back up. Can you wait the length of time it takes for it to go back up? And so just like keeping that in mind, like, this just goes like exactly to short-term predictions are hard. The system is too complex to be predictable. Even if you get a prediction right, you can get the outcome wrong. There's all of these, the whole system is conspiring against you. And so part of it is just like, be broadly diversified, put it in there, walk away, come back in 10 or 20 years. Because stocks, time is your friend. Stocks have always been long-term wealth generators, and we can't expect the same in the future. So hopefully this leaves us a bunch of time to talk more, and for everyone else to kind of share their tips, tricks, concerns, questions as we go through. I'm just going to leave this up just for a minute, and then I'm going to stop sharing so that I can see all of your beautiful faces. But certainly, like, if you could share, like, does investing feel painful or exciting or neutral right now? Have recent events influenced your investing strategy? What do you have? For those of you who've been through this before, what can you share with the group to, help us weather market downturns? And then for newer investors, what are some of these questions you have about investing when the market is down? And then if you want to ask something in private, you can always reach out to me privately. You can just put Austin Women's Investing Group member in the subject line and send it to me here at sarah@blackburnfinancial.com. Oh, all right. I can pull up my screen share again if I need to. But on that note, what other questions, or like especially kind of on that market timing question, does anyone else have thoughts or strategies or ways of thinking about things that they can share with the group?
So it does look like kind of on the same topic of timing, but in a different way. Sherry B is asking, what investment strategy would you recommend for people who are close to retirement?
Yeah, I mean, if you're close to retirement age, I would take that conversation we had about recessions and stretch it out. So the way that I typically think about getting ready for retirement is, if you're close to retirement or in retirement, first, you have to have a very clear idea about what your budget is. Most of us have like our baseline budget, our kind of splurgy budget, and our bare bones budget. So knowing what your actual budget and your bare bones budget are very important, because then look at your portfolio and see if you can carve out somewhere between 3 to 5 years of expenses in low risk assets like cash and bonds, because that's your worst case scenario bucket, right? Like if the stock market continues to go down and if it takes a long time to recover, like 2008, 2009, you don't want to be in a position to have to sell stocks when they're not cooperating. The only way to do that is to not have that money in stocks. So if you're getting ready for retirement, it might be kind of like what Caitlin said. It might be taking a year or two and bulking up that piece of the portfolio so that you're ready in 2 or 3 years when you get there. If you are already retired, it's taking a hard look at what you've got and how you've got it split up. And if you can answer the question, like, where would I get 5 years of living expenses? If you can answer that question, I think you're in really good shape. Does that make sense? Really good question. What else, Gwen?
Oh, Sherry said yes, thank you. Okay. Emily has a really interesting question. So as someone expecting to sell some stock for a down payment in the next about year or so, she's debating selling now and putting it in Ally at 1.4% versus waiting a while and watching the market, or something in between. I'm curious what folks think or what they would do.
Oh my gosh, that's a hard
Anybody
one.
want to weigh in? Yeah, that's tough.
This is like, yeah, this is like prediction time, right?
It's like playing roulette with your money.
Right.
We could extrapolate your idea of saving in chunks. Emily could, if there's a sudden pop, like, if it goes up 2 or 3%, maybe you sell a bunch, stash that away, then wait a while, maybe a month or two, sell a bunch, then stash that away.
That's interesting. Like
spread
the
it out.
reverse dollar cost averaging. Yeah, it's like it's dollar cost averaging just on sales instead of purchases.
Maybe, Emily, if you did that, it wouldn't be as painful. because you don't really know what's going to happen.
Yeah. I mean, if you would have asked me 2 weeks ago, 3 weeks ago, I would have said, oh man, we're going to 3,400 easily and maybe 3,000. But the way the market has reacted in the last 3 weeks to bad news is very surprising. I mean, so now I'm like, I don't know what's happening, right? I don't know.
I should also mention that I'm currently selling my house and under contract. So the last 3 weeks have been very stressful because everything has been everywhere.
Are you able to go back and ask the sellers for a little bit more? Is that an option?
Sadly,
Probably.
I think those days have ended, but so it goes.
Yeah,
I try to remind myself that you never buy, it's like very difficult to buy stock at its all-time peak. So why should I expect to sell my house at its all-time peak? But still, it's painful.
Yes. Yeah. It is. I mean, because part of it, I mean, you're right, Emily, like part of it, like when we're making these decisions is like, you know, being gentle with yourself. Like nobody is top ticking or bottom ticking anything, right? Like we're all just trying to keep it on the rails, right? And, you know, there are very few financial, I found that there are very few financial mistakes that you can't recover from, with the main one being out of the market for too long. You can't recover from that because you run out of time. And the kind of the idea of like selling into a loss and getting out for a long period of time, that is really the main one that trips people up. Everything else is kind of like, okay, we're just trying to work like in a range of like good outcomes. We're never going to have like the perfect outcome. And hopefully we're trying to avoid like the worst case scenario. We're just in a range of like pretty good. You know, we're all just trying to be pretty good investors, I think.
No, not just pretty good. I want to be more than that.
What's up? Oh, I had someone who I think.
Wait, who said that? Who wants to be better? We have to know. Tell us your secrets.
Seriously.
Well, I want to be better, but I don't have any secrets yet. I'm studying. I did put a question in the chat, but I can reiterate it if you want.
Yeah.
I was wondering if you have a method of analyzing stocks or if you think funds are better to go for. That's one question. And then the other question is, if you're looking at individual stocks, I've been looking into value investing, and I'm still learning on that, but it seems to be a way to determine the price you're willing to buy at, not timing the bottom, but to see what's a good price so that you're not overpaying. What do you think about that? Yeah,
Really good question. I don't do a lot of individual stock analysis. I wouldn't say exclusively, but predominantly stick with funds. And maybe it's funds that have like certain characteristics, like a value fund or a growth fund or small cap or large cap or something like that. So I don't have a favorite way of analyzing stocks because I don't really do a ton of analyzing stocks. There might be other people in the group that do. And if you are an individual stock person, if you could drop resources in the chat or just interject here as soon as I'm done, that would be awesome. On the value investing side, value investing is really good for super disciplined people because value investing, like you said, it entails doing a ton of fundamental analysis on a company, trying to calculate what they call intrinsic value, and then waiting for the price of a stock to hit that intrinsic value, having the discipline to buy it at that price, and then having the discipline to sell it when it's above the intrinsic value. So I would say, like, if you're interested in value investing, I think one of the best ways to learn it is to follow really well-known value investors, right? Like follow their newsletters, the mutual funds that they probably run. Follow them on Twitter, like follow them wherever they go, and figure out how they do the calculations and how they think about the world. Because value investing is a little bit tricky in a world that is dominated by technology these days. Being a value investor, until about a year ago, being a value investor was the most painful place to be, because there really haven't been what most value investors would think qualifies as value. There weren't a lot of opportunities. I mean, I'm talking for like 10 or 15 years, not like a few years, like decades, right? And so a lot of value investors either have kind of sat by the wayside for a long time, or have just kind of given up on the style. So I would say, like, certainly like Warren Buffett is like the most well-known value investor. So you can certainly like learn a ton from learning about Warren Buffett, reading Intelligent Investor by Ben Graham. But you also have to know that, I was just talking about the Intelligent Investor, the book, with someone the other day. You also have to know that a lot of that stuff is out of date because of the way the economy has changed over the last 100 years. That the way you analyze a company probably has to change, because analyzing, especially like something that has a technology component, is really different than analyzing a lot of the companies that were in existence when the Intelligent Investor was written, but in the 30s or 40s.
Right, a long time ago.
Yeah. It's tricky. Yeah. Good question. Does anyone else do individual stocks? Betsy, do you have a strategy?
Betsy, sorry, Betsy, you're muted still.
Sorry. I took a basic financial accounting course, but I really don't necessarily look at all of their business statements. I look at the earnings per share. I look at the price compared to their sales. I look at their PE. And then I look at the chart. I like to look at the chart since 2000 and see what happened in the crash, just to see like how bad they went, how they recovered. And I like dividends. I live on dividends. So I like to see, have they raised their dividends? Did they ever have to cut their dividend? There's so much information just on that. And if their PE is high, maybe they're building factories, maybe they're, what are they doing that's making them spend more money than they have? Just look at the terms, and there's so much, like, you could watch YouTube videos all day long. What does this mean? You don't have to look it up and not understand the language. You can just watch some young kid tell you what this means and what that means. You just have to be able to pay attention for 3 minutes so that you can put it in your head and maybe listen to it over and over, so suddenly it makes sense to you. But there's so much of, I want to say one more thing that I'm doing, and they have like 1 month CDs, 3 month CDs, 6 month CDs, 9 month CDs. So for your $200, instead of putting it in your savings, like if my savings says no money, but if I have a CD, then I can just space it out. Well, maybe the market will be better next month, maybe better 3 months, 6 months, those kinds of things.
Oh yeah, the CD ladder. I know, I was just talking to someone about that today. It's sort of become more interesting this year to do something like a CD ladder, as the Federal Reserve has raised rates. And you can get, I don't know, I think you can get a 12-month CD somewhere for like 2-ish%, maybe?
Three. It was three.
Three.
Yeah.
A 12-month CD at 3%. That's bananas.
And the U.S. Treasury is usually a little higher. A bonds, whatever. They're choices. Awesome.
Thank you for the people dropping notes in the chat box for like where you can get these I mean, we haven't had 3% on CDs since 2018, and that was really only on 3-year CDs. So a 1 year at 3% is bananas compared to 0, right? So for those of you who maybe have a little bit of cash that you don't want to put in the market, it's not for that. Betsy's idea of like maybe doing a CD ladder, like 6 months, 12 months, 18, 24, and having a chunk mature every 6 months. That's a way to like kick the can down the road and just say like, I'll make another decision in 6 months when my next CD comes due. Either I'll roll it into another CD or maybe I'll invest in something else. I love that. That's great. Thank you, Betsy, for sharing. That's awesome.
Can I?
Sarah?
Oh, go ahead, Lisa.
Sarah, this is Lisa. I was curious I've got money sitting in a total bond market fund, index fund. Are you better off to stay with the overall core, or should you try to diversify some of that into short term and inflation protected?
Oh, that's a good question. I would say if you're in a core bond fund at this point, my inclination would be to just hang in there.
That's what I've been doing.
Yeah, it was a brutal first 6 months. But again, like coming back to like longer term yields have stabilized around that 3% number. So now you're collecting a 3% yield on your bond fund, hopefully something like that. And if there is a recession, that core bond fund should perform well in a recessionary environment. I mean, if it was me, and I'm not saying this as a financial advisor, like if it was me, I'd probably just stick with the core bond fund, especially if it's just like the bond allocation of my portfolio. And if maybe if you wanted to add new money to a short-term bond fund for some period of time, maybe do that. Because it does look like the price declines in those bond funds, oh my gosh, I hope, are behind us, right? So now like we're already there, right? It's too late to sell, right?
Right.
But that 3% that you're getting now will start like reaccumulating, right? 3% is better than 1.5% at the beginning of the year. And again, that would be expected to you, if there is a recession, your core bond fund should be a good place to be. It should hold up well in a recession.
Okay.
Because you would expect those longer term rates to go back down if there's a recession, and then the price of your bond fund would come back up.
Right. Thank you.
Yeah, you're welcome. That actually reminded me of another thing that they've been saying on the financial news, which is like, as of like 3 weeks ago, kind of what everybody was saying is like, well, it's too late to sell and too soon to buy, right? You're just kind of like stuck in this like no man's land of like, oh no, like, no, I just have to gut through it, I guess.
Sarah, I want to bring up Susan's question from a little bit further up in the chat. I know that you had talked about like individual stocks, but what about stock sectors? If you zoomed out to industries or sectors, what would you focus on buying during this time? Or anybody else?
Yeah, I'll start and then I'd love to hear what other people have. So generally speaking, if you would expect inflation to persist, and if you expect inflation to persist and the economy to keep growing, something like value should do okay. Value stocks tend to do better when the economy is growing, right? And a lot of times you have inflation because the economy is growing. It's like an unpleasant byproduct of the growth. So think about like oil and gas or like financials. It's like if the economy is growing, then people need money from banks and they need, oil and gas, energy, building materials to build stuff. And so then you would expect value to do well. If the economy is going into recession, you would expect value to do poorly, and you would expect growth stocks and technology to find a floor and to kick up. So since at this point in time, it's very difficult to say which direction we're going.
Yeah, I agree. Well, right now, like you mentioned before, at the start of your presentation, we're pretty much in a downward trend of the market. If you look at the, the charts over the last couple of weeks, months, and so on. What I've been seeing, because I swing trade pretty much daily, is what we'll get is like these little pops, like, for instance, this week, and then also the latter part of last week, we're getting these pops. But then as soon as it runs up like a couple of days, it pulls right back into the downward trend again. Yeah. So I would be careful if you're trying to get into the market, because that's basically what I've been seeing over the last couple of months. So, and no one knows, where the bottom is or when it will bottom out. But with all of the swan events and the other things, I got a feeling it's going to continue to downward trend. So as a swing trader, what is your level on the upside that would break the downward trend? Do you have that on a chart? I do not. I've been looking at other people's charts and connecting with other traders. I go to a lot of investor business dailies too, to get the sentiments of people who actually trade people's portfolios as well that are financial. And they're all saying like similar things, seeing things that they're pointing out on their charts as well for downward trends. Because sometimes, when you're trading alone, you kind of self-doubt yourself. So you want to get, see what other people are saying, and they're right on par with each other. Yeah.
I love listening to traders and looking at their charts. And I find myself like trying to identify, every investor has like you get attached to your story, right? And so like with levels, this is where like I'm so fascinated by like the idea of levels and technicals, right? With the way people draw the charts, because like if it's technical and you're not emotionally invested in it, then there's a point at which like the narrative shifts, right? From like downtrend to uptrend. And it, certainly like the charts look very bad, right? Over the course of this year.
Yeah. I mean, you're getting some nice pops
trend, right?
and those are profitable too, but I would be caution about that, because, it can reverse very quickly. And then you have to factor in, they're saying the Fed is going to, I guess, be speaking or doing something on the 21st. So you have to factor in those things and these swan events we've been having lately with the Russia thing. Who predicted that? And then that's affecting other things like, the oil, gas, and all of that. And a lot of the stuff that ran up that time, some of the stuff is starting to retreat now slightly. Yeah. So, and then them raising interest rates here, the factor there, because I was actually overseas when the pandemic happened. And while a lot of countries were pulling back, the US was like inflating our markets with money. So I was watching that abroad. I'm like, and then we were having all these runs, and now they're having to basically reverse what they did in a sense of dumping money into the market. So, yeah.
Really good points. That's very interesting. What else you got, Gwen?
Some of the tools that I use out there, I drop them in a chat. I use FinViz a lot. That shows a picture of like if you're into graphing and looking at like what sectors are doing over the month, you can pull it by what it's doing by the month, 3 months, the week. If it's in a downtrend or uptrend, you can kind of get a feel of what each sector is doing, because it does it by percentages too there. It gives you like a overall visual, and then you can drill into charts to see, what particular stocks are doing in a downtrend. It shows a little bit of information of like who's selling out of funds, who's, buying into them and stuff like that. So, yeah.
I mean, and so to zoom out, like what Marlene is talking about is it's shorter term time horizons to make investing decisions, which requires a ton more effort, right? So just all of the things that she just said now, like the things that she keeps track of, is a lot of work, right? And so just kind of be ready for that if you go down that route. Like there's there are all different ways that you can incorporate, technical analysis or trading into your strategies. Just be prepared to spend time on it. And if you don't have the time, then it might be the case that while you're investing your money, you're not timing it correctly, right? And that you're exposed to more downside, but you're getting the money in and you're letting over the long term time take care of it over time. And that's how like most people who aren't doing this on even a part-time basis, like if you're going to be investor, that's kind of the other alternative, which is putting it into the market, doing it through 401k, more buy and hold style. It means kind of going back to Emily that you're never going to, hit the top, you're never going to hit the bottom, and you're going to have to get through hard times, but you can still be a really good long-term investor doing that, right? That's like those 10% rates of return that we looked at in the slides was just someone kind of buying a dumb S&P 500 index fund and letting it ride for 20 or 30 years. So just that there are lots of different paths that you can take. And part of what makes this group so awesome is that we have so many people doing so many different things, right? There's lots of ways to skin a cat when it comes to investing. We haven't even talked about like real estate or, cryptocurrency or the other things that people are into.
Yeah, that's what I was like wondering, is anyone doing that and anything with self-directed IRAs and stuff like that? Because I saw IRAs in the chat. So yeah.
Someone tried to get together a trading subgroup. I think maybe they even met once, but I don't know if. So Marlena, I would say like, if you're interested, I know there are people in the group who are into technical analysis. Mm-hmm. And they would be interested in meeting, but we haven't had someone who could kind of like facilitate the sub meetings, if that makes sense. But
okay.
If that's a thing, mm-hmm. then reach out to Gwen or Lori or myself.
Sure, I would definitely be interested. Yeah,
because I know there's people interested.
Okay, great.
Or Marlena, you could even post in the Facebook group and see how many people are interested, because I think that's what Colleen did Colette did with the rental property and living abroad.
Oh yeah.
Yeah.
Okay. I'll definitely check it out. Is your Facebook on your Meetup? That's how I found you guys, is via Meetup.
Yeah, if you're on Facebook, just Google on Facebook, just search Austin Women's Investing Group, and we have a private group that we can approve you.
Sure. Thanks.
I have a request before we end. I want Nicole, if she wouldn't mind, to tell us how the Berkshire Hathaway stockholders meeting was.
Oh, yeah.
I think that's cool that she went.
Sure. Yeah. Can you all hear me?
We can.
Okay, good. It was so much fun. It was my first year going. I dragged my husband, who ended up actually enjoying himself. And for those who haven't went, it's, a whole big multi-day extravaganza. Friday, they have the exhibit hall with all of the, iconic consumer-facing Berkshire companies, displaying their wares. And, as a shareholder, you can purchase things at a discount. So like, See's Candy and Nebraska Furniture Mart and Borsham's Jewelry and all these, kind of Omaha-based companies. And then Saturday was the actual shareholders meeting, and, it's held in this huge stadium, and, thousands of people come from all around the world to come listen to Warren and Charlie answer questions. And to me, that was the most fun. They, as well as, at the beginning, their two vice chairmen answered questions, for the bulk of that day. And it's really cool. I mean, as a shareholder, you just feel so welcome. Like Warren is just, you can tell he's just having a fabulous time, hosting all the shareholders. And you see a lot of, regular people. We saw families with kids, and, I think they select people to ask questions who aren't, you know, like so-and-so investment banker from blah, blah, blah. It's more, you know, student from NYU who's a shareholder. So it was just so much fun. I highly recommend going if anyone has interest. Like, I don't think you'll be disappointed. And if anyone has specific questions, I'm happy to answer them.
Oh my gosh, next year should we have like an Austin Women's Investing Group like road trip or like caravan, like meet in Omaha? we can have like our May meeting in Omaha. That would be so fun. I wonder if we get a sponsor for that.
I'd go again.
That's awesome. Oh my gosh, that's amazing, Nicole. Thank you so much for sharing. That's so fun.
Sure thing.
I love it. Awesome. Okay, well, I think we are out of time. Thank you, everybody, for sharing everything that you shared in the chat and on the questions. I love kind of these roundtable styles. If I could go back in time, I would have carved out a couple of my slides to leave more time for roundtabling. But for everybody who shared resources, thank you so much for doing that. It's like what the Austin Women's Investing Group is for, and it's what it's all about, and it's why I love you guys and love showing up here. We're still trying to figure out kind of what the next part of the schedule looks like for August, September, October. So stay tuned. We'll let you know as soon as we know. And in the meantime, if you have any questions, if anyone wanted to lead a topic for the Austin Women's Investing Group, reach out to myself or Gwen or Lori, and we can tell you what it's like. And we definitely, we're volunteer run, and all the people who come in here and speak to the group do it on their own time. So we rely on volunteers to keep things moving along. So I guess without further ado, we'll say goodbye for now, and then keep an eye out for the next few meetings, and we'll see you at the next one. Cool. Thanks, everybody. See you later.
Bye, everybody.
Thank you.